Good evening. I hope you all had a great day. Today, the market was quiet on this mid-August Friday, as it struggled to end the week strong but still had slight gains for the week. The S&P 500 struggled yet again to reach new all-time highs, which were previously set in February, as the index was essentially flat with a loss of 0.02%. The Nasdaq was the worst performer, as big tech struggled, which caused the index to fall 0.21%. Lastly, the Dow was able to post a quiet gain of 0.12%. The biggest news of the day was the retail numbers. Retail sales, which constitutes consumer spending at places such as service stations, stores, restaurants, and online retailers, rose 1.2% throughout the month of July, according to the Commerce Department. As a matter of fact, July's numbers topped the latest highs, which were reached in February by 1.7%. Though the rise of 1.2% in retail sales did come in below economists' expectations of an increase of 2.3%. This is big news, as February was never affected by the economic downturn of the pandemic. All isn't so rosy though, as spending is expected to have moderated in August due to the expiration of enhanced unemployment benefits. Other data does suggest the notion of an economic recovery, as industrial production, which is a measure of output from factories, mines, and utilities, rose by 3% in the month of July when compared to the levels in June. Regardless, this is good news, as retail sales is a big part of consumer spending, which happens to historically be the largest contributor to the United States GDP, coming in at around 68%. Also note that the economy has added millions of jobs in the past 3 months, including 1.8 million just in July. Initial jobless claims fell below 1 million last week for the first time since March. Still, layoffs remain exceptionally high, as employment is down nearly 13 million from February, and the jobless rate is still at a historically high 10.2% in July. An agreement on the very critical coronavirus relief package looks to continue to be elusive, as the Senate has finished their session and will not return this month unless negotiators are able to reach an agreement. Again, negotiators signaled that they were unable to make any progress on reaching an agreement. On top of this, negotiations are not expected to move much further, as each party will have their attention on their respective 2020 political conventions. If they return next month without an agreement, lawmakers will have to consider coronavirus aid while trying to avoid a government shutdown by September 30th. In case you missed it yesterday, Freddie Mac and Freddie Mae, which were created by Congress as a means to provide liquidity, stability, and affordability to the mortgage market, added a widely criticized fee. They said that they will be adding a 0.5% fee on newly refinanced loans as a means to protect themselves from losses on refinanced mortgages that they guarantee. The government-controlled companies back nearly half of the $11 trillion U.S. mortgage market and said that lenders will begin to be charged these fees next month. Industry officials said the fee isn't correlated with the risk of refinanced loans and would simply be passed on to consumers, increasing their costs at a time when the Federal Reserve was acting aggressively to support lower interest rates. Borrowers would likely see only a modest increase in their monthly costs, since the fee would be paid over the life of the loan. Many are questioning this decision, and the Trump administration does not seem to be a fan. A senior White House official said, quote, "The White House has serious concerns with this action and is reviewing it. It appears only to help Fannie and Freddie and not the American consumer," end quote. At their current level of roughly $150 billion a month in guarantees on refinanced loans, the new fee will increase the company's revenue by $9 billion a year. To top this off, mortgage lenders have already been reporting record earnings due to the refinancing boom. This fee would lower their future profits. The moves by the sector showed the quiet day in the market. Oil and gas, which had the best day, had a gain of 0.9%, while the other best performing sector, which was telecommunications, gained less than 0.5%. Utilities was the worst sector by far, as it lost around 1%. Healthcare also managed to fall a bit more than 0.5%. Value stocks were up as a whole today, but again, the gains were not huge. Core was essentially flat, while growth performed the worst, with small cap growth falling 0.66%. The best performer in the S&P 500 today was McKesson Corp, which is a pharmaceutical and healthcare company. Shares rose 4.22%, even though the sector as a whole fell the second most today. This move comes after it was announced that the U.S. government is adding McKesson to its Operation Warp Speed, which means that McKesson will produce and distribute a coronavirus vaccine once one is approved and available. The other best day came from DXC Technologies, which is a company that provides business-to-business IT services across the world. Shares rose by nearly 4%. However, I was unable to find any piece of recent information regarding the company. The worst performer was Dexcom, which is a company that specializes in glucose monitoring systems for those with diabetes. Shares fell 2.32%, which isn't too bad for being the worst performer in the S&P for the day. Again, I was unable to find any news regarding the company. The other loser was Duke Realty, which only lost 2.3% on the day. Duke Realty is a REIT that is the nation's leading domestic-only industrial property REIT. For those who do not know, REIT stands for Real Estate Investment Trust and are commonly known for their dividend payouts. Per usual for this Quiet Friday, there is no news regarding this firm, even when looking at the past few days. Getting into earnings, we'll start off with DraftKings, ticker symbol DKNG, which is an online sports gambling platform. This morning's earnings were mixed. The company missed GAAP EPS by a large 38 cents, as the company lost 55 cents per share. Quarterly revenue totaled $70.93 million, which was an increase of 23.6% on a yearly basis and managed to beat estimates by $3.08 million. The revenue growth is pretty remarkable, considering that there were hardly no sports for the majority of the second quarter. Looking ahead, DraftKings sees revenue of $500 million to $540 million in fiscal year 2020 on a pro forma basis. Growth is still on the agenda as DraftKings is working to enter Virginia and Tennessee for sports betting and Michigan for sports betting and iGaming. DraftKings was hit pretty hard today by the IRS though, as it was reported that the IRS wants daily fantasy sports companies to pay federal excise tax on entry fees. Obviously, this will lead to a large loss in potential profits for all online sports betting companies. Shares cratered nearly 6% after the tough week for the sports industry as a whole. Lastly, we have Remark Holdings, ticker symbol MARK, which is an artificial intelligence company that works with companies to deliver results in a variety of industries, such as construction and risk management. The company had a GAAP loss of 11 cents per share, which missed estimates by a large 6 cents. Revenue fell nearly 20% for the quarter, as the company had revenue of only $2.3 million, but did beat estimates by a comparatively large $990,000. The company ended the quarter at $10.2 million in cash and cash equivalents, after raising $32.1 million in proceeds from common stock issuance, which was partially used in debt principal repayments of $13.3 million. Shares had an abysmal day, as they fell more than 14%. Next week, retailers such as Walmart, Home Depot, and Kohl's report their quarterly earnings, which will give us a better sense of consumer activity during the pandemic. Thank you for watching, as that is all that I have for tonight. It'd mean a lot if you could leave a like and subscribe. As always, I hope you have a fantastic weekend, and I look forward to seeing you again on Monday.